This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, you're probably wondering, when would you ever get to the end of Chapter 2? Well, I'm very pleased to tell you that this is the last session that you're going to have to endure in relation to this particular chapter. I did forewarn you it was a particularly large chapter as it lays down all the basics of the preparation of the income tax computation. There are one or two other chapters within the course notes that get close to this, but we're never going to have to deal with as much as this. Indeed, some of the chapters will only take probably 45 to 60 minutes worth of presentation. So don't panic that you're going to have every other chapter as long as this one in terms of the lecture content. What are we left to do with there, or deal with, in this final session together? First of two areas, something called, as you'll see here in your notes, the child benefit income tax charge. Now, the state, the UK state, provides various state benefits depending upon your circumstances there. And one of those is a child benefit. It's a tax-free benefit that used to be universal, and to an extent still is, by which we mean, irrespective of the level of taxpayer that you are able to be provided with this particular state benefit. But until relatively recent times, that was it. Whether you were a basic rate taxpayer, whether you were a higher rate or even an additional rate taxpayer, everybody got the same, and it was an exempt benefit. What has now happened is, although the benefit itself will still be exempt, if we discover that we have an adjusted net income, a figure I'll remind you about in a moment, if you have an adjusted net income in excess of £50,000, then you start to lose the benefit of that state benefit in the form of a tax charge placed thereon, a figure that will be added in deriving the taxpayer's overall tax liability. Again, it's a sliding scale. We're used to the idea, like with the personal allowance, of an erosion of a benefit, there the personal allowance, and not falling off a cliff whereby, well, that's it, you go above that level of income and suddenly you get nothing. No, again, there will be a pro rata reduction in it, such that if your adjusted net income exceeds £60,000, then you'll end up with nothing, because the child benefit income tax charge that we receive here, and we'll calculate in a moment, that income tax charge will match the amount of benefit that you have received, thus removing it from the taxpayer. So what are we told in the note, therefore? Again, payable to parents to begin with, irrespective of the level of taxpayer they may be. If, however, a person's adjusted net income, or whose partner adjusted net income, exceeds £50,000 and they receive child benefit, a child benefit income tax charge will arise to gradually remove the benefit from such higher income earners, such that, as we said a moment ago, when that adjusted net income reaches £60,000, at that point you'll have a child benefit income tax charge. The benefit will be entirely removed because the charge will be equal to the amount of child benefit that you received. Now then, adjusted net income. Remember when, again, we were looking at the restriction of the personal allowance. Adjusted net income was the key figure. There we compared it with an income limit of £100,000. What we have here is an income limit, effectively, of £50,000. Now again, this information about 50 and 60 will be provided to you. Let me just flag up this note here, because this is what you are going to get in relation to your rates and allowances table. Now the first bit, where income is between 50,000 and 60,000, that then tells us the nature of the erosion of that benefit, the amount of child benefit income tax charge that will arise. But the figures of 50 and 60 are given to you. How we then apply that reduction, we'll see that in a moment's time. But remember what adjusted net income is. Obviously, to begin with, the net income taken off the face of the income tax computation itself. But what do we mean by adjusted net income? Now, you tell me, I know, difficult to do over the screen here, but you tell me, you think, what is that adjusted net income? Net income less either or both of two things, which you must know. That, of course, was the gross amount of either gift aid payments made or indeed personal pension contributions paid there. So again, those two figures are relevant in deriving the adjusted net income of the taxpayer. Now then, we talk about here partners, so we're not talking about necessarily married couples or civil partners, but those who live together as such. So again, we refer to this term partners. Now then, we said up here that if our person's adjusted net income or whose partner exceeds 50,000, then we're going to, if we receive a child benefit, we'll get this child benefit income tax charge coming in. If both partners have income over 50,000, the partner with the higher income would be in fact liable for the charge, though that issue will not be tested in fact in our exam. So, as long as the taxpayer's adjusted net income does not exceed 50,000, there is no child benefit income tax charge. If our adjusted net income of the taxpayer or the partner of the taxpayer, as we've said here, if their adjusted net income exceeds £60,000, then the amount of the child benefit income tax charge will be equal to the amount of the child benefit. So what happens in between? Because we've got to think, if they're going to test this, you're probably looking at an adjusted net income that will fall between £50,000 and £60,000. Well, the rule is, where that adjusted net income falls between the £50,000 and £60,000 figure, our income tax charge will amount to 1% of the child benefit received for every £100 of income in excess of £50,000. If I take you back to what's provided on your rates and allowances, again that information is given to you. Where income is between 50 and 60, the charge is 1% of the amount of the child benefit received for every £100 of income over £50,000. So how would that system work, therefore? Now, clearly, you're not expected to know what the amounts of child benefit are. They will be determined, of course, according to how many children the taxpayer has, and they are set down. Any such figure will be given to you within the question. So you will be given the amount of child benefit received. What you then have to do is to calculate this, the child benefit income tax charge, and that income tax charge, once you've computed it, is added in deriving our income tax liability at the bottom of our income tax computation there. So let's assume that we've done our calculation of adjusted net income, taking net income less the gross amounts of gift aid, less the gross amounts of personal pension contribution, and we've discovered an adjusted net income of £56,000. Well, £56,000 exceeds their 50,000. By how much? Obviously, 56,000 minus 50 will be 6,000. And we divide that excess by 100, because for every £100 of income over 50,000, we have a 1% charge. So 6,000 divided by 100 equals 60%. So your child benefit income tax charge will be, take the child benefit received, given within the question, and multiply it by 60%. And that figure of tax will be added in to your normal basic rate, higher rate there, additional rate if necessary. It'll be added in deriving the income tax liability. Notice here, this is added, not a deduction that we've seen before, but this is an addition there in deriving the income tax liability of the taxpayer. Now, a couple of things here about the calculations that you do. There I gave you exactly 56,000. Now, it's for every £100. But if that, instead of being 56,000 there, had been 56,090, you'd be rounding down to the nearest £100. You always round down to the nearest whole number here the nearest £100. So whether that's anything from 56,000 to 56,099, it is still going to give you 60% that you apply. You round down there. And when you work out your child benefit income tax charge, when you apply that 60% to the given figure, as we said, of child benefit received, then on that basis, that figure too would be rounded down to the nearest pound. Not a huge giveaway there, but we round down on each occasion. So with that in mind, let's have a little look at a couple of illustrations here. Catherine received child benefit of £1,056 in the 2017-18 tax year. Again, you won't have to know where these numbers come from, they will be given to you. And has adjusted net income for the year of £54,000. You may have to work out that adjusted net income. They tell you what levels of income the individual has. You put it together in a normal calculation of net income and then deduct from it, if you're told this within the question, any gross amounts of gift aid or personal pension contributions. So that figure again, a figure you're used to calculating, adjusted net income, you may have to do it again. So 54,000. So as Catherine's adjusted net income falls between 50 and 60,000, we now have to compute what percentage it will be that will be the child benefit income tax charge percentage to use. Well, that of course is going to be 40% because it's 54,000 minus 50 divided by 100, replicating the calculation that we've done there. Only this time, that of course will equal 40%. Applied to the child benefit received, that figure rounded down to the nearest pound there, rounded down to the nearest pound. That'll be, I hope, £422. Well, when you've got your basic rate, higher rate, additional rate tax, you add in that child benefit tax charge. Illustration 2. Victoria receives child benefit of £3,147 in respect of her 4 children and has adjusted net income of £77,000. We should be looking at this and think, thank you very much, this is not going to be difficult at all, no calculations will be needed because that figure exceeds £60,000. Therefore, the income tax charge will be equivalent to the amount of the child benefit. So, here was it Victoria? Victoria received from the government a benefit of child benefit of £3,147 in the tax year, and that is now taken back by HMRC in the form of the child benefit income tax charge. Okay, again, just make sure you practice those particular issues there, the sort of thing again that is so easily examinable within the format of an OT and objective testing question. Again, make sure you've understood the techniques at use. And of course, you understand that that information there really gives you your answer. As long as you understand what that statement means, you don't have to remember, you don't have to learn anything here, because you just have to read it out from your rates and allowances. Right. The last of the areas, we look at the taxpayer's residence. Now, there is very little in the way of overseas aspects of personal or indeed corporate tax that impact upon us in relation to this syllabus, our Tax UK F6 paper. It is at P6 Advanced Taxation where we have to look at in rather more detail the issues of overseas aspects of personal and corporate tax. All we have to know here is that a taxpayer's liability to the personal taxes, income tax, CGT and IHT, is based upon the taxpayer's residence and or, specifically in the case of inheritance tax, their domicile. But all we need to know here is about this term. Determining here whether or not a taxpayer is or is not UK resident. The outcome then is very simple. UK resident will be liable to income tax on worldwide income. What you discover at P6, if you are dealing with such a UK resident, and they have overseas income as well as UK income, all of that overseas income will be brought into and assessed on that UK computation. But then, of course, it is likely that some overseas tax has already been suffered thereon. And what does that give rise to? It gives rise to double taxation relief being given, crediting back basically the overseas tax against the UK taxation. But those are calculations that you are not going to have to do or worry about at this particular level. So, UK resident liable on worldwide income, whereas a non-UK resident will simply be liable on any UK income. So anybody, wherever they are in the world, if they have UK income, then that UK income will be chargeable to UK taxation. It is therefore essential to determine the residence of the taxpayer. If we don't know whether the taxpayer is UK or non-UK resident, we do not know whether to simply tax them on their UK income or on their worldwide income. And what we get tested on, and this again could be very easy tested in the form of an objective testing question, or it could be involved in relation to a part of a written question. But it lends itself more effectively, I would say, to an objective testing question. But what we've got to be able to do is to determine, based to begin with on the number of days that the individual spends in the UK in a tax year, to determine, using what are the statutory tests of residence, is that taxpayer UK resident or not UK resident? Now, you may be wondering, of course, how do we determine whether you are in the UK or not in the UK on any particular day? That's based on where you are at the end of the day, at midnight at the end of the day. Are you in UK? Are you not in UK? Therefore, are you UK resident? Are you not? Again, in an exam question, they're probably likely to tell you what the number of days are, though you may, if given various dates, have to work that one out for yourself. But is a day a UK day? Yes, if you're in the UK at midnight at the end of that day. Now then, here is a table that, thankfully, in that form is provided to you again on your rates and allowances. Thank goodness. That is not something that you would wish to have to learn. And what we've now got to do is to understand how do we apply that to determine whether or not the taxpayer is or is not UK resident. Down this left-hand column, we are looking at how many days that you are in the UK. And the fewer days that you are in the UK, the better the chance is here for you to be classified at the top of this table as being automatically not resident. The more days you are in the UK, then the greater the risk of you being classified as automatically UK resident. If you're UK resident, you're liable on worldwide income. If you're not UK resident, only UK income would be assessable, and any overseas income of the taxpayer would be free of UK taxation. So it's a pretty critical call. That those taxpayers, again, who have varying numbers of days possibly in the UK and overseas, but a lot of overseas income, they may well wish to ensure that they're classified as non-resident so as to avoid UK taxation on their overseas income. So we've got the number of days here. The fewer the days in the UK, as we've said, the better the prospect of being automatically not resident. The longer you are in the UK, so coming down here to more than 183 days, or 183 days or more, I should say, then you're going to be automatically resident. In between, you will discover where you're neither automatically not UK resident and you're not equally automatically UK resident, then how do we determine? Are you or aren't you? If you're not automatically one or the other, how do we determine which it is? And here are rules that say that you would be resident, there that's the R, resident if you have a certain number of ties with the UK. Sadly, that's one of the bits that you're going to have to learn. They don't actually give you the list of ties, what represents a tie to the UK. that's what we're going to have to learn for ourselves. What you'll also see is we haven't just got one column, we've got two columns, talking about whether a taxpayer is said to be previously resident or not previously resident. Now, this again you have to learn. In that table there, a taxpayer is previously resident if they've been resident in any of the previous 3 tax years. If you've not been resident in any of the preceding 3 tax years, then it is this column that you look at. And very clearly what you can see from this column is that if you were previously resident in the UK, then there are fewer days that you have to spend in the UK to be classified as UK resident. You're only allowed here to be in the UK for up to 15 days, less than 16, to be automatically not resident. Whereas someone, principally here someone coming to the UK who has not been previously resident within the previous 3 years, they're allowed more days in the UK and can still be classified as automatically not resident. So, that's the first thing. Those columns, therefore, was the taxpayer resident in any of the preceding 3 tax years? So you need to know, first of all, that characteristic to know whether we're looking at this column or whether we're looking at this column in terms of our analysis. We'll use these columns in examples soon. That table shows that the following persons will automatically be treated as not resident in the UK. As we've just seen, anyone in the UK for less than 16 days. If, of course, you were not resident in the previous 3 tax years, then a person in the UK for less than 46 days. Those people automatically not UK resident. Another one that you're going to have to learn, so again let me flag this one up, where automatic non-UK residence status is achieved. A person who works full-time overseas and who has not been in the UK for more than 90 days in the tax year is automatically not resident. Now again, you will not have to define full-time work. You will be told this at this particular level, not something extra you have to learn. But you have to recognise that a person who is in full-time work overseas and is in the UK for, and who has not been in the UK for more than 90, so not more than 90 days in the UK, then that person automatically not resident. And that's the first test that you apply. When you look at the days in the UK, you look at the status of the taxpayer as regards their previous residence, it is that test that you apply first. And if they satisfy that test, that's it, job done. The taxpayer is automatically not UK resident. You go no further. If they're not classified as automatically not UK resident, we then move to the second step to determine whether you are automatically UK resident. And that, as we can see, has the same number of days, 183 days or more spent within the UK. Again, the above table shows that any person in the UK for at least 183 days, that's basically 6 months in the year, they're half the year, is automatically resident. The following persons are also treated as being automatically resident. And again, ones that you have to learn. Again, this is a learning exercise for you. A person whose only home is in the UK, they're going to be automatically UK resident. A person who carries out full-time work in the UK, again, you'll be told whether or not that is the case. Those persons automatically UK resident. If, as it is quite likely in a question, you are dealing with a taxpayer who isn't automatically not UK resident and isn't automatically UK resident, the number of days in the UK and otherwise their status does not make them automatic one or the other, then it is about the ties tests. Now then, the ties tests, no pun intended. The tests here. What do you think would tie an individual to the UK? Family, of course. So if your spouse or civil partner or minor child, i.e. under 18, is in the UK, then that is a tie to the UK. If you have a house in the UK which is used during the tax year, obviously if your only home, go back to that, if your only home is in the UK, then this is not about a ties test, you're automatically UK resident. So you may have someone, of course, who's got both property in the UK and property or properties overseas as well. So it's not their only home. If they have such a house in the UK, that is a tie to the UK. Next one. If in the UK for more than 90 days in any of the 2 previous tax years. Again, a statement of fact. In the 2 previous tax years, were they in the UK for more than 90 days? That would represent a tie. Actually, these would be better the other way around. I'll explain why in a moment there. But if you're doing substantive work, again, you don't have to define it in terms of this level. You will be told whether or not that is the case. Now, there I've picked out 4 of the 5 tests. That one is only applicable for people who are basically leaving the UK. For where you were talking about someone who was previously resident in the UK and is now leaving the UK. That test of more time in the UK than in any other country in the tax year is only an issue, only a tie test for someone leaving the UK, i.e. someone who had previously been resident in the UK. Again, at any point in any of the previous 3 years. Okay, what would happen on that one if you were to do it? They would simply tell you that the individual has travelled from one country to another, to another, to another, and how many days they spent in each country. If the most amount of days spent in any one country was in the UK, then that is a tie. But again, only applicable for those who had previously been resident in the UK in any of those previous 3 years. As I said earlier, a UK day is where the person is at the end of that day, at midnight at the end of the day. You may think that these rules are complicated enough. The detailed rules are even more complex, but that's the limit on what we have to know. Now, what I'd suggest that you do here is to go back through what we have just seen, read through those notes again before attempting these particular illustrations. So what we'll do is we'll have a little pause at this particular point to allow you time to do that, and then come back and we will work through these particular illustrations here to make sure that we've got a grip on what these rules are. Clearly it's about a learning exercise. Probably at this stage in your studies, depending on how close you are to exam day, it is about understanding how the rules work, recognition. Obviously at some point closer to the exam day, you're going to need to have learnt all these rules as well. But we'll see how to apply them in a moment's time. So pause, go back through, have a good look at them, try and get them into your head, just again for 5 or 10 minutes reviewing through what they are, maybe playing back some of the lecture so far, and then we'll test ourselves out with those illustrations. Okay, hopefully therefore you've had a little revision through. Let's now have a look at some of these illustrations, some rather more basic than others, as we will discover. Now, to be able to analyse these situations to determine is the taxpayer UK resident or not, we need to be able to determine, firstly, are they or were they previously resident in the UK, to know which particular table we are looking at, which column on the table we're looking at. And then, of course, if we are automatically not UK resident, based on the very few days that we spent in the UK, that automatically applies. End of story, not UK resident. If we're not, or if we don't qualify as automatically not UK resident, we then have to check, are we automatically UK resident? If so, again, that satisfies it, you are resident. But if you're neither automatically not UK resident or automatically UK resident, it is then about, again, based on were you or were you not previously resident in the UK in any of the previous 3 years, how many ties do you have with the UK, and how many days have you spent in the UK? And then we read it off that table there. So if not already, you might want to, again, have that available to you rather than flicking back from one page to the other in your notes there. Again, that is available on your rates and allowances pages. But again, that income tax information you should have out and available to you as you work through all of these examples. So let's have a little look at our first example here. Okay, Sebastian was not previously resident in the UK. Not previously resident in the UK. So now we know which particular column we're looking at. The previously, or as here, not previously resident columns. So how many days were then spent in the UK? Spent 35 days in the UK during our tax year. For someone who was not previously resident in the UK, for them to qualify as automatically not UK resident, it has to be, let's go back to that table. There we go, not previously resident. You're automatically not resident if up to 45 days in the UK. Well, we haven't exceeded that. We are not in the UK for 46 days or more. It's only 35 days, as I recall here. There we go, 35 days. So on that basis, automatically not resident, as in the UK, for less than 46 days, having not previously been resident in the UK in any of the previous 3 years. Automatic, not UK resident, end of job, nothing else to do, answer determined. Gets a little bit more interesting now with illustration 2. Again, Fernando was not previously resident in the UK, but bought a holiday home in the UK on the 1st of May 17 and lived in it for 140 days within our tax year. The remainder of the year he lived in his home in Spain. So the UK home is not his only home. That again is relevant to us because had it been his only home, he would have been automatically UK resident. But that's not the case. So what do we do? Which column? He was not previously resident. So has he been in the UK for less than 46 days? No, Fernando was in the UK too long, more than 45 days. Lived in it, that house, for 140 days there. So in which case, too long to be automatically treated as not resident. So we don't get the automatic non-UK resident status. So now we look to see, was he automatically UK resident? Well, if we look at the criteria for automatic UK residence, automatically resident, someone not previously resident, well that it's applicable to both columns there, is if you're in the UK for 183 days or more. Well, he wasn't. There, young Fernando was only here for 140 days. So, not long enough to be treated as automatically resident. And as we said, nor did he have his only home in the UK, otherwise that would have made him automatic UK resident. So, we've ticked off as not being applicable. He isn't, I best say, he isn't automatically not UK resident. He isn't automatically UK resident. So now it's a question of looking at how many days was in the UK and how many ties that he had within the UK. 140 days. So 140 days comes into that category there, 121 to 182. Was he previously resident? No, he wasn't. Therefore, he will only be resident if he has at least 2 UK ties. Resident if he has 2 UK ties. Now look at the information that we're told about Fernando here. All we know is that tie him to the UK is that he has a home. He bought a holiday home in the UK there. so he has a house in the UK. But looking at our other tests in relation to this, no reference to any spouse or minor children. Yes, he does have the house in the UK. That one wasn't applicable. No, he wasn't in the UK for 90 days or more. That one's not relevant. Doing substantive work in the UK, no. So he's only got one tie with the UK. On that basis, using the table, as he's been in the UK for between 121 and 182 days, not 183 days or more, he's only got one tie with the UK, made use of a UK house. So as he was not previously UK resident, he's therefore not UK resident in our tax year 1718. Illustration 3. Lewis was in the UK for 80 days in our tax year when he lived in the only home that he owns. Now again, we're not given information about the past, but on that evidence, I think it would be clarified in the exam question, but there we may assume on that basis that Lewis was previously resident in the UK. If he were not to be, you would have to be told that. So, Lewis was in the UK for 80 days in 2017-18 when he lived in the only home that he owned. Now, that is going to be critical, but remember, the first test you look at, based on the number of days in the UK, was he automatically not UK resident? Well, with 80 days, whether in fact he had been previously resident in the UK, or whether he had not been previously resident in the UK, 80 is more than 15, 80 is more than 45 days. So whichever background he had, it doesn't matter. 80 days is more than 15, it's more than 45, so we do not rank as automatically not UK resident. Do we rank as automatically UK resident? Well, not based on 80 days, because he's not in the UK for 183 days or more, but that is the critical information here. His only home is in the UK. Look as if I can make that work. Only home in the UK. So Lewis has been in the UK too long to be treated as automatically not resident, irrespective of his previous residence there. He will, however, be treated as automatically UK resident as his only home is the UK. That's the criteria. Not based on the number of days. 80 is not at least 183, but based on the fact that his only home is in the UK. And finally, our pièce de résistance here in relation to our examples, illustration 4. Jensen. Always been UK resident, so he's previously UK resident. Spending about 10 months of the year in the UK, but on the 1st of May 17, purchased an apartment overseas where he lived for most of the tax year, returning to the UK for a further 50 days in 2017-18 when he stayed at the family home with his wife and children. Right. Was he automatically not UK resident? No. He was previously resident in the UK. He spent more than 15 days in the UK in our 17-18 tax year, so he won't be classified as automatically not resident. So therefore, will he be classified as automatically UK resident? Well, no, he won't be automatically UK resident, as he's not spent 183 days, nor does he have his only home in the UK. He's got the overseas apartment, of course, which is where he's been to, so it's not his only home in the UK. So again, we do not satisfy either of the automatic qualifications for non-UK resident or UK resident status. So it's about the ties. So, how many days, therefore, was he in the UK? Now, if we look at the information there, on the 1st of May 17, he purchased an apartment. So he'd been in there since the 6th of April in the UK, and then for a further 50 days. Well, 30 days in April, 6, so we're talking about another, 24 days, so about 74 days-ish. So what category does that put him in? between 46 and 90 days. Let's go back and remind you of that table. There we go. That is the category he is in. He's been in the UK for 46 days or more. He hasn't been in the UK for 91 days. It is that criteria. He was previously resident, so he'll be resident if he has 3 UK ties. Now again, without you looking at the answer, just think now, look back at the information provided to you. Does he have at least 3 UK ties? If he has such 3 UK ties, then he will be classified as UK resident. If he doesn't, if he only has 1 or 2, then he'll be not resident. So what can we see here, therefore? As we read through the information, we know, of course, that he's got a home in the UK, and of course, not just before, but after his period overseas, he stayed there. Not only does he have a home in the UK which he's used during the year, he's got wife and children. Again, spouse there in the UK, let alone children, though we're not given their ages. So that is another tie that our individual has with the UK. So we've got spouse or children in UK, house in the UK, that is only 2. Again, you're going to have to memorise these ties tests before you walk into that examination room, because that one then was the critical third one, which means that Jensen is indeed classified as UK resident. He's in the UK for more than 90 days in the previous 2 years. Again, looking to the information provided here. Where are we? Spending about 10 months of the year in the UK. So that again would mean, yes, more than 90 days quite clearly within the UK in the previous 2 years. So we've got the 3 ties based on the number of days in the UK. Therefore, he is UK resident. He will indeed be classified as a UK resident. So that status, he has been UK resident. He will remain UK resident for this tax year. Okay. That, therefore, as you can see, is some learning exercise here. If you're still many months away from your exam date, you're not going to try and learn those ties tests at this point, but you're going to think about them. Again, what would bind you to the UK? Family, property, a house there, working in the UK. And where had you previously been? Like in the 90 days in any of the previous 2 years there. These are the things that would bind you. And if you think about that logically, suddenly, actually, it's not such a big learning exercise after all. I've got family, I've got house there, I'm working full time, or working in the UK. That's the sort of thing there that would bind you to the UK. Okay, that you'll be very pleased to hear now is the end of this particular chapter. Some rather shorter chapters to follow there, with chapter 3 and chapter 4. Chapter 3 looks at our property and other forms of investment income that we've made mention of, but we need to look precisely for each of these sources of investment income, which is basically dividend income and interest income, and also then at property income, at how we determine the assessment. What is the basis of assessment there? Dividend income is very easy. We work on a received basis. Interest income is basically very easy as well. We work on a received basis. The property income is the bit in chapter 3 that will take more time. Because if you've got a property from which you gain rental income, then you're probably going to have expenses that you'll incur as well. So what we've got to work out is what is the rental income to include for the tax year, and deduct from it any allowable expenses that we've incurred. And that's where your main rules and issues will arise. Plus a few other little things thrown in for good measure, but that's in our next lecture together.